Hello and welcome to Investing Confidential. They keep telling us the Fed is data dependent. Okay, you as an investor, you should also be data dependent because the data should matter at this point. Now, we've talked about how reliable the data is. You have to sift through the reliable versus non-reliable data, but at the end of the day, it's really the economy. Okay, the data is a leading indicator for the economy, and the late data over the last couple of days has really been bad. Okay, I can't even I can't even sugarcoat it. Okay, consumer confidence in February down. From let's say an index of 108 down to 102. The February Chicago Purchasing Managers PMI down to 43.6 versus 45. I mean, folks, we're sinking here. Okay, take a look at the Kansas City Fed, the Fed data, fairly reliable data, manufacturing data down. Okay, similar data with Dallas Fed down. Okay, Richmond Fed down. I mean, down hard. You also have the Kansas City Fed, and these numbers are coming every month. They're cutting employees work weeks. Okay, there's no demand, folks. You're seeing employees, small businesses, cutting down work weeks, there's no demand for anything right now. Okay. Consequently, GDP has been revised lower, okay, led by consumer spending. This is critical here. We are a consumer-led economy. The consumer is over-levered and it's not spending. And yet, the talking heads in the White House and others are telling us, oh, the economy is in good shape. This is what they say. This is incredible. Okay. Look at durable goods orders. Okay. Is this economy in good shape? Not, I mean, geez, I mean, anyone with two eyes can see. No. Look, okay, then you've got consumer credit delinquency rising rapidly. As we saw before, we could have credit card balances at $1 trillion for the first time ever. Delinquencies are rising. So we are now hitting uh, an inflection point, okay, in terms of the economy. We are sinking. If they say we're not in a recession, we are sinking into a recession hard. Okay, it's going to be a hard landing. And then you got the last few days of housing data have just been getting worse. We've talked about housing ad nauseum. It's a leading indicator for the economy. Okay, you're seeing it now in prices. Look at the Case-Shiller index here, the chart. Prices have already peaked. And if you think like I think, okay, that we are going into a recession, probably worse than 2008, 2009 because of the interest rates, again, because of inflation. Prices can go down 30, 40% from here, and probably in some cases even lower because of the spike was so much. So in some cases, in some markets like Arizona, Texas, Austin, Texas, other hot markets, prices go down more than 40% off the peak, maybe 50% off the peak. Everything's going down to what it was before the pandemic. That's what I've been telling you, including stocks. Stocks will not bottom till they test the pandemic lows, the March pandemic 2020 lows. I feel that way. I may be completely wrong, but that's when I'm sticking to my guns, and I think we're going lower. Okay, let's continue with housing. Inventory of existing homes spiking up. Okay, new home inventory also spiking. But those numbers are easy to manipulate. The home builders can manipulate those numbers big time, so I don't even pay attention to them. But if you look at what I think is a reliable indicator, a single family months of supply, it's showing how bad things are. And we're not even we're just beginning. Okay, so inventory is going up higher, and we're going to see inventory really start to pick up dramatically in this sort of March to May period. Okay, again, existing home sales sinking lower. Okay, this home sales, medium house price sinking lower and lower and lower. We're not even close to 2008, but we're going to get there. Okay, we're going to get to that same data. Look, houses being bought by investors down to 2008 levels. Obviously, it doesn't make economic sense anymore. You can't buy a house and just rent it out. The carrying costs are too expensive. So all of these buyers, which were institutional buyers, and then you had the last year, you had a lot of individuals jumping into the market at the wrong time. They're all gone out of the market. Those buyers are gone. Those are the incremental buyers. They're out. Okay. Again, some other incremental evidence. Look at Wayfair, big seller of furniture. They lost 5 million customers and 1.3 billion towards the end of last year. Recently, earnings of Home Depot and Lowe's today or yesterday tell you your story. Sinking home sales because Home Depot and Lowe's generate a lot from home sales, and the consumers tapped out. Existing consumers who own houses that they don't even have money to even do renovations anymore. So this is the state of the economy. Okay, and I'm gonna give you some other anecdotal evidence about the economy in general. Here is cobalt. Okay, cobalt prices. Okay, cobalt is a key element for smartphones and even more for EV. What does this tell you? So cobalt prices are down massively. Okay, there was a big spike in cobalt and now it's down massively. Again, leading indicator. What does it tell you for Apple? The sale of smartphones. Not good. What does it say for Tesla? Any EVs? All these cars jumping into the EV market. They caused a big spike because remember, you have to build that inventory early, all right, a few years before you build the car. So there was a big spike, and now you've got nothing. Okay, basically because the consumer is not buying any EV cars. They're not buying more Apple phones. As I said before, this is the first time in my life that myself and my family, I think we have a total of 6 phones on my account. We don't have one phone on a contract. First time ever. Everyone has their old phone. They're keeping them. Not old, but that tells you right there. And then the gall of economists, people like Kramer and other morons to say we're not in a recession. I mean, this is a joke. Okay, you can't believe these people. You can't believe a lot of the data, but the Fed data is telling you where we're going. Okay, as I showed you. And then there's inflation. Okay, if you're excited about recession, hey, we're in a recession, maybe the Fed is going to start cutting. Nah, look at the inflation data. Non-core PC inflation back to the highs. Okay, that's not good. Global inflation spiking into decades high. That's not good. Crude is base. Crude is starting to break out, folks. You're going to see crude break out into the summer. It's not going to be good. Hey, you got terminal rate heading to 6%. Okay, last week, Meister, she's in the Fed. She's a voter. She's saying inflation's too high. She's saying rates here are going to 5%. So if the short-term rates are going to 5%, what's 10-year going to do? 10-year's going up. And what's that's going to do to mortgage rates? Mortgage rates are going to explode past 7%. And then you've got the whole housing. I mean, so the bottom line is, I hate to consistently be negative here, but this is what the data is telling us, and the Fed is data dependent. So as long as inflation continues, the Fed's going to keep rising into 2024. Forget about pivots in 2023, any cuts at all. We're going to see rates rise in 2024 and then hold steady. And the economy is going to go right down the tubes. Okay. And the next video, I'm going to talk about the global economy, again, because we are linked, and it's not good either, even in some cases, even worse. So if you're an investor, you really have to be careful out there.